Well, good morning or good afternoon, wherever you guys are in the world. We cover all the time zones, all the time in crypto. So thank you guys for agreeing to come onto this panel. We're going to talk about traditional finance moving into decentralized finance. And so a very hot topic, probably one where that has the most attention and spotlight on it. So maybe just to get started, and I'll dive right in, is be great to have a quick intro on yourself, your project, how you got to be on this panel, maybe why it's relevant to what you're working on. So let's start with Sam. I'm going down the participant list on the Zoom.
Sure. Hi guys, I'm Sam Senchal. I'm the founding partner of AbEx Capital. My business is predominantly focused on bringing institutional and ultra high net worth and endowment style accounts into the blockchain space, whether that's participating in DeFi or liquidity provision or algorithmic trading, but effectively a platform for those people. Our background for the team is in quantitative trading, institutional fund management. My partners used to run a very large US investment bank, and we are really focused on working with protocols and working with projects that look to solve a problem that traditional finance hasn't been able to solve. We're looking to launch in Q1 22, but really got put in touch through a mutual connection. And this is a good opportunity to meet people in the network and to work with some guys doing some interesting projects.
Awesome. So Chandler.
Yeah, hi guys. Great to be here. Chandler from the UMA protocol. Very briefly, what UMA is trying to do is build the infrastructure for legal financial contracts, basically any type of legal financial contract to be built in DeFi native way. We have a kind of a contract layer that you can use to build out your payment terms and kind of just set it over a different, whatever time horizon that you want. And then as an added layer on top of that, we have a dispute resolution layer that kind of acts as what a typical legal element behind, like if there's a dispute between a legal contract in traditional finance, you go to a lawyer, someone arbitrates that. Can't really do that in DeFi. So UMA has a resolution layer built into it that helps arbitrate these legal financial contracts.
Samir.
Thanks, Lee. First, really nice to see you again, Lee. Excited to be part of this in the Harmony community. I'm Samira Ghosh, Director of Product at FalconX. We're an institutional digital asset prime brokerage. And fun story, 3 years ago when I joined the team, Harmony was one of the first projects in the ecosystem that we had the chance to interact with. And we worked pretty closely together early on. So it's really nice to be reconnected. What we focus in on is sort of bridging the world of crypto with the world of traditional finance through what we call prime brokerage. So we offer trading, credit, custody, and structured product offerings for clients who are hedge funds, proprietary trading shops, sort of large-scale asset managers that range between managing $10 million all the way up to billions of dollars. And so I think the insight maybe I can try to offer in this conversation is, when those customers come to us as a centralized counterparty, what do they look for? And what does that mean? Or what does that mean about what they might look for from centralized participants as well? What holds true in both worlds? And really excited to be here today.
Yeah. And Tony, to you.
Hi, everyone. My name is Tony Chen. I'm the founding member of Pledge. Pledge is a decentralized lending protocol built on Binance Smart Chain, and we do fixed rate lending. Our target borrower are people from the crypto world. Those are whales. We mainly help them to diversify their crypto asset into other asset classes, just like real estate. And we also work with miners. We help miners to get loan for them to pay for their electricity. I know Lee and the Harmony team for 5 years now, right? Yeah. Play a lot of basketball. And I watched the amazing team grow, right? Harmony is one of the best community. I see Harmony grow from before the private sale, right? 5 years ago, and did the private sale, public sale, listed on Binance and do it all the way, right? So I'm a big fan of Harmony and Lee and the team has been doing such a phenomenal job, and it's my honor to be here to contribute and be part of this. Thank you.
Yeah, awesome. Thank you guys all very much. I think one interesting thing is maybe for you guys are in the industry talking to institutional investors, traditional finance folks, like maybe take us inside the mind of institutional investors today. Like you've obviously noticed evolution, how they think, where are we? What are people thinking about? What are the questions? What are the frictions for getting them into DeFi? I'd be really interested personally because I don't interface with them much, but you guys do every day. So Sam, go ahead.
Yeah, I guess so. This is all my business does. My business is an institutional platform. We've worked with 5 of the top 10 European insurers. We're banked by Citigroup at the moment on a £250 million fund. I think the core things, and this was one of the themes that I wanted to raise, is there is a gap, one, in the knowledge base of the people making capital allocation decisions within a pool of capital that would support the liquidity of these systems to the extent that they actually became really, really, really useful as payment networks or really useful as platforms to host decentralized finance applications. I think currently when I look at something like a Sushi Swap or a Uniswap, for a retail client, they're very straightforward and very easy. But when you go to institutional frameworks, one of the things that these platforms really don't allow is particularly good audit of the market making tools, audit of the tech stack, support of the back end. Is it insurable against? Is there counterparty risk? So all of these red flags that would go through a compliance committee to get sign off to deploy $100 million worth of liquidity on a network are reasonably impossible. And I think it's just a translation issue where participants in the decentralized finance space, their background typically is tech-led as opposed to finance-led. And these are internal things where potentially these organizations taking on senior people on a non-exec basis who have that regulatory framework, who can help them navigate that space, will enable an adoption of these products far faster and a utility for them that's much higher than currently, because everything I've just said basically means volatility, limited liquidity, and therefore the adoption curve for getting institutional capital on board is just much slower than it could be. But lots of words, and there you go. That's sort of the heads up from my LPs who I'm currently raising money from. So these are sort of some good points. There's some points that I've experienced in the last month.
Yeah. And Samir, I mean, your business is all about interfacing and working with these. What do you think?
Yeah. So a lot of thoughts. I'll try and structure it to make it useful. But I think just to contextualize the response, where are we today in the grand scheme of where DeFi could be? I think I just checked DeFi Pulse this morning, right? $85 billion as of this morning is locked up in a variety of DeFi protocols. Compare that with the 250 trillion fixed income market cap, globally speaking. And so there's huge opportunity if we can find ways to build bridges to these institutions and entering. And so I think of institutions when I think about institutions, I sort of bucket them along one axis, which is risk. Institutions that we're talking about are risk managers. Now, the way in which they look at risk, I think, varies in depth and in scope and breadth, dependent on how big that institution is, the number of regulators they interact with, the number of LPs, as Sam mentioned, they have to report to. And so to start, where's this 85 billion coming from? I think of it as coming largely from the folks who have defined their scope of risk largely to market risk. They're market risk managers, they're counterparty risk managers. They're usually trading their own funds, proprietary trading shops. And there's maybe some exposure of funds that are, high net worth individuals of the likes, but generally speaking, they don't have layers of that much more risk than they need to manage. Now, as you move sort of down or up the stack in terms of the scale of institutions that we'd like to involve in this ecosystem in order to create the next set of financial rails, the risks start to magnify and multiply. And I'll just take by way of example, we're interacting with some banks that want to, use FalconX's services. So what are the questions that banks are asking are us, and are they going to ask of DeFi? Think of it in terms of like 4 or so main buckets. I think they have a layer of security and counterparty risk they want to dive into, right? And DeFi today, I think, $600 million was just hacked on the Poly network, and in the first 7 months, $400 or $500 million was also hacked. And so a lot of these institutions may not have the technical expertise in-house to do that layer of security vetting, or if they do, it might not be freed up, and that's going to slow their ability to come into the space. Counterparty risk is really security risk in the way I think about protocols and DeFi. The second is compliance risk, and we can dive into each of the buckets in more detail later on in the conversation. But a lot of folks are doing great work in terms of creating permissioned pools that have continuous AML monitoring, where counterparties are KYC AML'd in order to onboard. So that's another problem that they have to solve for. Legal risk, so they need documentation and auditability. If something goes wrong, how is the issue going to be resolved? These institutions are used to relying on the court of law for that. And so if there's other systems that are going to exist that we're going to build to solve those needs and address those needs, whether that's through insurance, through Nexus Mutual or something like that, should be aware of it. And then the very last is sort of like brand and reputational. So, if you're Goldman Sachs or Franklin Templeton, a lot of the reason your customers come to you is because of your brand, because of your reputation. It's built up over, centuries, quite literally. And so it's a tough ingredient to, I think, solve for from a tech standpoint, but it's a place where maybe partnerships can come into play to help catalyze the amount of reputation and brand that we can build in the DeFi space.
Yeah. So speaking of which, maybe Chandler can chime in on how does UMA protocol, do you think it'll solve some of these problems, get adoption, or work with other intermediaries to interface with institutions? Like, how do you see your role in bringing more comfort to institutions?
Yeah, I totally agree with the points that were raised around counterparty risk and some of the legal ramifications around, how can we build these? And actually right now, a lot of these questions are unanswered at the moment, right? Like we mentioned it, somebody mentioned it earlier where they said DeFi is very tech centric, and it really was born out of just a bunch of like really smart engineers deciding, hey, I want to create something that's interesting that doesn't need somebody else to kind of act as an intermediary layer. And ever since that like idea cascaded into what became DeFi, we're now in a position where the skills gap on the rest of the financial industry, from like legal, regulatory, compliance elements, all of that is still kind of ongoing at the moment. So the way we kind of look at it from UMA's standpoint is that a lot of the regulatory elements behind just getting institutional players involved will be kind of its own trajectory, and it will happen over time as we solve for many of these very specific issues, or in fact the regulatory landscape has a more directed understanding of exactly what DeFi protocols do and how it can fit within their space, right? That's still a very unanswerable question at this moment, and there are many approaches that are being taken with that. So we tend to think that it will happen in the future, and how that happens is not somewhat of an unanswerable question. We can take the best punt that we can at the moment, but it's not super unknown. But what we do know, and when you mentioned the whole, like, on the one axis there's this risk management layer, but the other axis, which you probably should have added as well, is like the amount of return that you can get from there. And those two are correlated, right? 100%. So if we're seeing really awesome and kind of innovative ideas that generate a lot of yield, the risk profile for many of these risk managers are going to change. Right. And if you look at institutional players that are looking for different types of yield that might want to take up some more risk, they're going to look at places like DeFi as a change in some of their portfolios. And it might not be a large amount to start, but it'll be enough just to kind of get the ball rolling. And once that ball gets rolling, maybe more and more and more and more will come into play. At the same time, many of the regulatory elements will come into play. So I kind of see it as a little bit of a hockey stick growth. as time goes on, and maybe, and this is my hope, that the time horizon for when banks got into crypto versus when banks get into DeFi, like, will be an exponentially shorter time.
Yeah. And Tony, to you, as a new protocol project, are you targeting retail, or are you targeting institutional investors? How do you get, how do you, as a relatively new project, get institutional investors to come in and be lenders or borrowers?
Still very small and tiny. We're a startup. We mostly focus on individual whales, right? From the beginning. But we do talk to banks. We have two advisors. One is Mr. Terry Say. He's my Stanford alum. He is an independent director of Paribas Bank, BNP Paribas Bank.
Yeah.
So I talked to them, and they say they're interested in deploying capital into DeFi because as a bank, they have a lot of deposit, and these deposits are liability for the banks, and they're always looking for more product for yields, right? And behind the banks, they have a lot of investors also, right? And they're all looking for higher yield, right? As you know, in the US, everybody have a lot of liquidity these days, right? Our government constantly print a lot of money, and putting money in the bank give us 0.5% interest rate, right? So they're all looking for a different place to park the capital. We also signed up another advisor, Nicole Chang. Nicole is my Stanford alum since 2016. She is the senior VP at the East West Bank. They are looking into doing something in the crypto space also. Yeah. So I should introduce you later. She went to Harvard undergrad. JD from Stanford, and also the president of the Stanford Alumni Association. Yeah. She is one of our advisors. She used to work at East West Bank. So I talked to this bank. They are looking into getting into DeFi. So yeah, but for us Pledge, we mostly focus in individuals right now. Yeah.
Yeah, but I think the core point, right, and apologies for not stating the obvious, but most of those banks that you guys are talking to in that time process that you speak of is banks taking client money on from investors or other people, and it would be the same, another version of retail, but slightly bigger and slightly more sophisticated. So what they'll do is their initial capital that they'll plug into the DeFi world will only be probably private wealth management or wrapped bond for treasury management. It's what we're really talking about here, to onboard banks in a material way that actually contributes to the cost of capital in these networks going down, which is fundamentally why they become useful, is they need to have a regulatory framework. And right now, if you look at Basel III or you look at NAIC, which are the NAIC's insurance reg framework in the US, Basel III European bank framework, they don't have a way to capitalize against holdings in this. So banks on their own balance sheet who have access to the borrow window, who have access to effectively unlimited printed fiat liquidity, can't transfer that liquidity onto a blockchain just because some bureaucrat has not yet written that every 100 million that you hold in liquidity on a pair in a DeFi platform, you have to hold 10, 15, 20, $30 million of equity capital against it, because at the moment there are not even metrics for how they track that. And until these banks have ways to calculate return on equity for these, until they have a capital charge against what they're putting up, and it's the same for insurance, right? And that is, 70% of productive capital flow globally comes from those two sources: insurance, pensions, banks. And until that happens, until those things are done, it's going to be slower than it needs to be. And the things that people, when they build a front end for a DeFi solution, need to think about building in that reg framework from the front end. There's businesses like ITI and Marek Spectrum that are creating wrapped bond products that could easily be on chain, but they're effectively enabling institutions to hold it for treasury management purposes. And you want to move the space on from being, there will be space for arbitrages in this market forever because you need it to make an automated market maker work, but effectively you want sticky liquidity in a market because that's when the service becomes viable. And not enough people, in my view, in the DeFi world are focused on integrating with the regulatory framework which unlocks capital. At the moment, I think it's very nascent and people are still talking about onboarding individuals, because that's the easiest, it's unregulated. And that's just a barrier that exists, and it's a sticky barrier, and it takes 18 months, 2 years to go through that process.
Okay, we can keep it open, or I do have another question. So you guys are all entrepreneurs in a lot of ways, or founders, and so put your entrepreneur's hat on. We have a lot of developers coming to this hackathon. They're looking, they may be from the traditional finance world. Like, what are some things that they should look at building? And the second part is, like, do you think they have a good opportunity to build something in this space? Like in DeFi, it's easy because you can, fork something and just launch it, and launch a token, launch anonymously. There's so many things you can do. But once you touch the traditional finance world, it probably gets a little bit harder. So how would you guys think about, if you were like part of this hackathon that we're running right now, like, how would you think about opportunities, challenges, or like advice for the developers?
Well, one area I would actually jump in on quickly is to think about something that Uma's been focusing on for a while. Sam was mentioning it earlier on these treasury management solutions. And I mean, there's an idea of like traditional money coming into the crypto space, and that's been chatted about. I mean, I still remember when in 2017 in the first bull run, once that first bull run happened, everyone was talking about the money from institutional players flowing into crypto. And like, depending on what metric you would look at, that either happened or not. And it's so, sometimes these things take a little bit slower. One area which I would think is of extreme value in the DeFi space is no one would have ever thought that a DeFi protocol could have $1 billion balance sheet in their own tokens, one token, super huge, just like one bit of risk sitting there, and they can't sell it like immediately, and they have to find these very interesting structured products to be able to transfer that risk around, or diversify their balance sheet, or actually get a different type of currency that developers want to be paid on, because you've got to pay bounties, you've got to pay team salaries. There's a lot that you can do there. And one of the areas which I would like to see some very specific interest, or would be personally interested in seeing, is how you could build DeFi native structured products that actually, instead of trying to bring traditional money into DeFi, build DeFi native structured products with DeFi technology right out the gate, like as if it doesn't need any transferring. And in that way, you can actually have a lot of lessons learned on like how you could actually leapfrog from kind of how they would do it in the traditional space, and like just build it in a DeFi way with like the tech that's available on DeFi right now.
One of the things that I think we're very focused on is insurance solutions. At the moment, financial markets develop in tandem. So borrow-lend markets, historically, if you look at the analogies, have developed alongside an insurance or a reinsurance market. So once effectively people have been able to trade, they've been able to insure those trades. And whether that's on-chain counterparty risk insurance, there are some startups looking to do it, but the contract design is not really insurance because it's a regulated activity. And I think that anyone developing insurance solutions predominantly around platform risk and counterparty risk, or any sort of insurance product that enables transfer of loan collateral, because most of the loans on DeFi platforms are collateralized, like that's capital inefficient, right? The only reason people are doing that is because they're trading every day. Like you want people who, if this is going to be used as money, like you can't have that. So I think those sorts of solutions need to evolve pretty quickly. And so far, because our background is life and P&C insurance and serving that market, the startups that we've seen in the space have not been particularly well thought out. And I think that is something where whoever develops the first on-chain insurance platform that can support, like, I've loaded up liquidity onto SushiSwap, but I want to pay 25 basis points so that if SushiSwap go down and my staking pool goes down, it's like staking pool insurance, downtime insurance, all these endemic products that could be easily built on chain. And I think that they're, something where your sort of network really is perfect for it because it's fast and it operates interoperably with everything. And that for us is a big theme.
Samir, maybe feel free to jump in.
Yeah, I'd add, I think that, the idea of going deeper, right, adding structured products on top of the borrowing lending that's happening in DeFi makes a lot of sense. The idea of adding insurance to reduce counterparty risk makes a lot of sense. Just to add to the list of areas where I think there's a lot of opportunity, there's only a few players in the space that are really diving into this notion of permission pools and permission access, right? What Aave is doing with Aave Arc, for example, and what some folks like Maple Finance and others are doing with permission access to under and uncollateralized borrow facilities. But I think just to expand, right, what you can do, the different mechanisms you can use to help scale permission pools and lower the barriers to entry. Whereas right now it's, only, trusted large institutions that are entering these permission pools. So how can you really lower the barriers to entry is a really, I think, interesting problem to think through. Second is like, how can you incentivize participants into the ecosystem to help ensure that all of the liquidity that's being pooled, all of the value that's being moved around, like that, fundamentally money laundering, terrorist financing, blood money, the stuff you don't want going through your protocol is not actually going through there, right? And so I think it's a huge opportunity and, something that we as a community should sort of stand by. Like, how can we ensure that, the value that we're helping move around more seamlessly, more efficiently, benefiting more users, is happening in a way that's, in some ways compliant, but also in other ways morally good.
Yeah, for sure.
The other thing thematically we've been focused on is any solution that enables transactions across chain in a way that's usable and i.e. is blind to a back end, right? Yeah. Like, I think one of the things that we have an initial view on, at least in our team, is that the world is probably a cross-chain world and that it's probably multi-chain, and that whoever takes a slice of the plumbing is going to be like, to give you context, again, most traditional financial people, you need to give them an analogy to something that's happened historically in the evolution of the financial markets, which luckily for this space, blockchain is basically the last 25 years. You can just pick a point in time, but the cross-chain point, anything that's producing something like a dark pool or a lit pool that links between different networks, like an island or an archipelago did for NASDAQ or for the electronic markets evolution, like an Instanet, that sort of service that can link up between different backends and different DXs and different chains, if they can, that service as a plumbing behind everything is required. And I think whoever's building stuff like that is probably in a very good space. Has to be able to do everything. So I'm sure it's technically much more challenging than I know how to talk about.
Yeah. I think that's right. Are there any, so DeFi usage is still actually quite small. If you just look at the number of wallets, for most of these, they're less than 1 million or even less than a few 100,000, right? So what do you think is kind of maybe the friction or the challenge opportunity there? How do we even like get to 10 million users? I mean, it's not a big number in the grand scheme of things, but we're not even there. So any thoughts on that?
Have you used any of these platforms and tried to load up liquidity and see how long it takes? I mean, the platforms are slow as hell. It's like version A. It's like 1992 Netscape Navigator at the moment. Like, this is not like Escape. This isn't Google. This isn't even Google to 1999. This is the products do not work that well. Like, simply, like, they are not that usable, right? They're not straightforward. They're slow. Transactions take time. Look, I'm someone who is traditional finance almost through and through, right? And I'm like, I have to load up liquidity. This is thematic. This will define my next 20 years of my work life. I went to load up not an unsubstantial amount of liquidity to an Aave pool. It took 8 minutes. Yeah. And then I wasn't sure if it had worked. And if I clicked the button backwards, it would have canceled the transaction. I probably would have lost the money. Like, you're talking about, like, like obvious barrier. Like these barriers are straightforward, and it's a function of the fact that the network that they're based on is going for an enormous upgrade that not many people understand, because they still think crypto as opposed to blockchain. And I think that, that's still, when the world is still day traders and, a lot of the flow in liquidity provision is effectively arbitraging, you're not getting useful utility capital. And until the services that are being built reflect a real world service or a real world problem, because all of the things that you can build on this, any sort of middleman invoice financing, factoring, where you're taking both sides of the market and taking a brokerage fee, that is traditional finance through and through. As long as you have to get to the end user though. You have to onboard the customer that needs that capital, as opposed to onboarding a native crypto user. And once those people start to onboard, it will become, that's when the double ledger accounting actually becomes useful, because then the whole economy starts to net up. And I think until that point, we're going to be talking about traders trading for a very long time.
So let me add something, right? Sam, I agree it's low, right? But that's why we need Harmony, right? So Harmony is a lot faster, right? Maybe Lee can, have you tried Harmony? I'm a big believer of Harmony.
That's why I'm on this call.
Wait, so Harmony is a lot faster, right? We don't see 8 minutes, right?
It's rapid.
So Harmony is important, right? Solving one of this slowness problem, right? So so I recommend Harmony, right? So
I wanted to add, actually, it's funny that you say 8 minutes is painful when that normal transaction in traditional finance actually takes 48 hours. So I think from a transactional standpoint, we might be on a quicker time horizon. But what I do think that your other point was like a lot more spot on is onboarding that user. Who that user is right now is a whole bunch of traders, and you're 100% right on that. But the minute you can get MetaMask to not feel like a dial-up modem, that's when you kind of get to the point where anyone can get onto the space, right? And so that's from a retail level. How do you get an institutional player? I think we covered that in the first 30 minutes. But I think the idea where we're at right now is like it's right at the beginning. And I totally agree with you, Sam, that like right now we haven't even thought of how quick we can get this industry to be, and like the types of transactions that we can like create in the future, and it'll get there eventually.
I don't doubt it for a second. I think the point you raised, right? You're right. It is faster, but this is the thing: no individual or even no business user sees the 48-hour clearance and settlement behind the transaction when they do the online deal. When you pay with your Visa card, right? They see it immediately decredited from their bank account, right? So as much as the focus of this industry from a tech perspective is we're doing it much, much better, and you already are. It's from the user perspective that currently it feels like a bit of a minefield to use it transactionally. I don't mean for people that are trading. I don't mean for people that have been in it for 3 years, and we've been around this space for 4, right? And I remember in 2016 when I was first looking at it, I was like, what the hell is Bitcoin? Like, this just doesn't work. Like, what are you talking about? And you see how it's evolved. So it will get there, and it's just going to be much quicker. But the things that will make it faster are definitely insurance, custody, compliance, regs. Like more than even a product that knocks out of the park. Because a product that knocks out of the park, you're going to have every regulator looking to shut it down straight away, unless you've engaged with them before. If you look at, there's a project called Eco that's got a lot of traction. It's one of the most heavily raised projects in the space. It's effectively like an open bank, and they're powering it with a blockchain technology, but they're trying to create, a coin or an internal currency for this banking product. And they've already engaged with regulators in Washington, in London, in the EU before they've launched. And that's why these things are acquiring so much funding. These things are funding a £70 million seed round. They haven't got product out. These things are so important, but once you break the back of them, you don't need to do it again. And I think that there needs to be teams and people in the space, and it's probably at a foundation level, that are focused on just engagement with those sorts of people. Because when I go and see a pension fund and I sit with a CIO of a pension fund or an insurance company, they just laugh. They they laugh at this space. They're still not even like, when I tell them like, you need to be, and I say this as a financial guy, I'm like running LP Money, you need to be, 1 to 5% of your AUM just has to be in this space. It doesn't matter if you think you're leaving it and doing nothing with it. They still look at me like, half of them look at me like I'm crazy. The other half is just hold it passively in a cold wallet. There is so much money held in cold wallets that should be participating in DeFi because they should be earning fees, they should be earning yield. They're just not, because the knowledge gap and the usability gap and the trust gap is too big. There's not enough people going, we will manage this for you. It's too venture investing and traditional liquidity investing or IRR investing or yield investing are two very different pools of capital, and their concerns are almost entirely different. So when you see the likes of Sequoia doing a huge fund and they're backing all these businesses with big checks, the businesses that will be providing liquidity to the ecosystem are not those businesses. They are yield players, and yield players have a much higher bar in terms of deployment of capital because their alternatives, as you said, with the 250 trillion market cap for the bond market, they have just so many more options. Venture has venture. And that's sort of the big point here, that the pools of institutional capital that are targeted by this space are currently mostly venture, and not bringing money into DeFi requires you to flip what you focus on when you're developing.
Yeah. Just to add, I think we started the question was, how do we get from 1 to 10 million, or forget that, 1 million to 1 billion users in the space. And I think that DeFi has done a great job of creating incentives for those that want to interact on a direct level with the protocols, right? Whether it's the incentives through comp rewards or all sorts of reward programs that are provided to early users and adopters of these protocols. But we're sort of reaching this point where maybe the growth rates aren't as quick as they were 6-12 months ago. But what we're seeing on the retail side is, if I were looking to go from 1 million to 100 million users, I'd go to the platforms that have those users and make it useful for them to expose their users to the benefits that DeFi provides. So, as a builder of a protocol, I don't really care if someone's, going to the Compound app directly or just through Robinhood, through PayPal, supplying the protocol with capital, right? At the end of the day, it's furthering the ecosystem and the growth. And so my, strategy or tactic, it would be to go to those, build useful tools, tooling for those aggregators to start to plug in. Because I can tell you for sure, in the next one year to 1.5 years, a lot of these neobanks and what we consider to be retail aggregators are going to be plugging in. And the ones that are too slow to move there are going to be playing quick to catch up. And the protocols that provide the most useful and easy to use tools that are also compliant, meet the concerns that we talked about earlier, will probably be the quickest to attract that liquidity and that volume from those platforms.
Yeah, no, I think that makes sense. So do you see basically more partnerships between the Robinhoods of the world and the AbEx of the world?
Yeah, I think we'll be seeing a lot more that looks like Compound Treasury, at least over the short to medium term. Which isn't to say that decentralization won't eat up all those partnerships and all those centralized intermediaries, because I think that there's net benefit in that end outcome. But it's more to say that that's I think, most likely path to getting the next wave of adoption and users.
So awesome. Maybe in the last couple minutes, I just love to hear what you guys see over the next 1 or 2 years. I mean, Samir gave a very good roadmap, but yeah, where do you think we're going? How fast do you think we're going? Is it still going to be a lot of friction, lots of bumps on the road, or do you see something that can just open up the market for everyone?
I mean, we're seeing through our private equity fund, one of the businesses that we own is already wrapping crypto futures, sort of $100 million institutional tickets, which they're hedging themselves on, through a Coinbase or a centralized exchange that gives them access to the market. And we're seeing that sort of wrap liquidity provision as a yield product, as a sort of listed bond or an unlisted bond. is becoming quite popular outside of trading houses as just a yield product, and we're seeing income funds start to look at those. I think that in the next year, the big thing that I think people will probably be looking towards is the Ethereum network upgrade, right? Like, the Cardano smart contract release on Plutus. These are two huge projects where they're meant to be, the bee's knees of when they get them done. And it's amazing to me that a £300 billion network exists that's almost totally predicated on executing a tech upgrade that no one has certainty of whether they're going to get to, which is just, it's amazing. That just shows you the power of network mathematics and value, right? Like, that just shows you that in and of itself. And I think that is the two things that you'll look towards for big adoption. I think, for us, we think that there's going to be a lot more data richness and data quality improvements in the next 24 months as people like FalconX, who are collating, I'm sure, a huge amount of data, start to look at using their data and selling it and providing it to market participants. And with data becomes analytical expertise, and then comes capital, and then comes liquidity. So it's probably that sort of next 2 years for me.
Chandler or Tony?
Yeah, I can jump in quick. I think maybe whether we get from 1 million to 10 million users, that will happen by itself, just as more people get involved. What I think might become more evident to me is whether one big institutional player is worth 10 million people, and which one would actually move the needle in the space a lot more. And so I don't know the answer to that question. I'd be very interested to see what comes of it. And yeah, the pace at which that happens, I think, is right now breakneck speed. It's one of the most fascinating industries to be in, because finances have been typically quite slow for many reasons, and we're moving at a pace where things like regulation come up in a time and space that's a lot quicker than it ever has been before. Security upgrades are happening in a far quicker space, and it's almost hard to manage just your news inflow on a daily basis. So I think the pace at which we're working at is the fastest it's ever been, and the same thing will be said for next year and the year after that, and the next integration after that, or iteration after that. And so ultimately, we're at the fastest that the financial technology space is moving, and it's just a really exciting space to be in. And I think that the estimation of time before these problems that this panel has discussed today, when those do get solved, will happen in shorter increments. And at least that's my big takeaway from what's happening in the DeFi space.
Yeah, just add something quick to get mass adoption. I think user experience is very important, right? What Harmony did is great, right? Have a wallet, right? Nobody needs to do all these seeds and remember the private key and all these things, right? Is important, right? I remember the days when I wrote part of Windows 95, right? So we came a long way, right, in terms of user experience. It's just hard for anybody, right? Think about, I just couldn't imagine how my father or my mother or my wife even, right, to download a MetaMask plugin, right, get all the private keys set up and transfer all these ETH or all these things back and forth, right? It's just way too much for them, right? My wife can only swipe a credit card, right, or take an ATM card and go to the ATM machine and take money, right? So if it's as easy as that to interact with DeFi, then mass adoption will come, right? But before that, I think we still have a long way to go, right? So that's why I see everything Harmony did is really important, right? And it's definitely going to the right direction.
Okay. Thank you guys for the time. I promised 45 minutes. So we can obviously love to catch up with each of you at another time. But yeah, really, really amazing panel. We're going to put this up, give it to the developer community. Hopefully they'll build on some of the ideas that were suggested today. And let's see what happens.